If you don't think it's happening to you, I'll guarantee you it's happening to you. Don't kid yourself. Brokers with checkered histories cast doubt on FINRA enforcement efforts. This article, published in Financial Planning on December 5th, 2025, critiques the financial industry regulatory authority of FINRA and its effectiveness in policing brokers with histories of misconduct. It argues that persistent gaps allow recidivist advisors to continue operating and harm investors. It highlights how FINRA's BrokerCheck database often fails to flag recent allegations promptly. Firms lack robust supervision for high-risk hires, and regulatory responses remain reactive rather than preventive. Drawing on a 2019 academic study, the piece notes that brokers with prior offenses are 5 times more likely to reoffend. Yet only about 1.7% of FINRA member firms, 61 out of 3,582, would face restrictions under a proposed new rule awaiting SEC approval. This rule would mandate high-risk firms to set up restricted deposit accounts for potential arbitration payouts, but it's criticized for narrow scope, loopholes, and limited public transparency. Key criticisms include slow detection and disclosure. Regulators and firms often act only after significant harm, with BrokerCheck omitting arrests or indictments until formal convictions. Inadequate supervision, principles-based guidelines don't enforce mandatory oversight for risky brokers, according to experts like attorney Christine Lazaro. Industry frustrations. Consumer advocates such as Lev Bagramian of Better Markets call FINRA's efforts a failure to clean up the worst of the worst, while attorneys like Joe Piefer decry pre-harm inaction. 3 stark examples of unchecked brokers. These pre-2025 cases underscore long-term patterns. Gregory Frank Estes, a Texas broker with a 2001 sexual assault conviction, a 2006 termination, and a 2016 investor settlement of $95,000. Arrested again in late 2020 for child assault, yet BrokerCheck omitted the new charges, and he remained active for over a month. Keith Todd Ashley, fired in 2020 for undisclosed outside activities, later arrested for wire fraud and indicted for murder. BrokerCheck ignored these charges, listing only a dismissed 1991 forgery. GPB Capital Scandal, a $1.8 billion Ponzi-like scheme defrauding 17,000 investors. Key figures such as Jeffrey Schneider with 20 disclosures, and Mark Martino with 10 disclosures continued working in the industry even after allegations. FINRA defends its work, barring hundreds annually and emphasizing exams, but the article portrays enforcement as reactive, urging stronger mandatory safeguards. Beyond the brokers, the firms as the root of the problem. While individual brokers and so-called advisors bear responsibility for fraudulent sales, the systemic issues originate higher up with Wall Street firms, major banks, insurance companies, and smaller broker-dealers. These institutions design and distribute conflicted, high-expense products that prioritize profits over investors. They mandate sales through incentives like commissions, revenue-sharing agreements, and proprietary funds. Investment banks have historically engineered complex, high-risk securities, mortgage-backed securities, CDOs, while simultaneously betting against them. Banks and insurance giants cross-sell bundled products like variable annuities with high-fee mutual funds, where upfront commissions of 5 to 7% encourage unsuitable recommendations. Smaller broker-dealers aggressively push crummy products such as non-traded REITs, unit investment trusts, variable interest rate structured products. FINRA has repeatedly cited supervisory failures and Reg BI violations tied to these products. Firms set the conflicted incentives at the top, turning brokers into salespeople for overpriced, opaque vehicles that erode investor returns. The barred broker, loophole, shifting to insurance and annuities. Even when FINRA bars problematic brokers, many simply pivot to state-regulated insurance channels. They obtain licenses to sell equity-indexed annuities and other crappy products that have far fewer federal investor protections. A 2025 study found 92% of brokers who dropped FINRA registrations kept their insurance licenses. 76% were authorized to sell variable annuities. These EIAs cap upside potential, expose consumers to downside risk, and include surrender charges up to 10%. Complaints surged in 2025 with variable annuities topping FINRA's grievance list. State oversight lags federal standards with no real-time disclosure tools like BrokerCheck. This allows recidivists to target vulnerable investors again. The revolving door underscores calls for unified SEC state coordination. 2025 FINRA enforcement. Highlights: proactive, yet imperfect. Despite systemic gaps, 2025 FINRA records show a ramp-up in disciplinary actions. Fines, suspensions, bars, censures. The 2025 Oversight Report expanded to 24 topics, including cybersecurity, AI in trading, investment fraud, third-party risks, and more. Enforcement Chief Bill St. Louis emphasized focusing on rooting out bad actors. Here are notable examples from 2025. May 2025, First Trust Portfolios LP, excessive gifts and entertainment violating Rule 2341. Missing supervisory controls on high-expense fund sales, $10 million fine. Violation spanned 2018-2024, aligning with critiques of slow detection. August 2025, small broker-dealer. Failed trace reporting, lax surveillance on high-fee structured notes, censure and suspensions, reveal supervision gaps at smaller firms pushing risky products. October 2025, political contribution violations, annuity sales quotas, fraud cases tied to bank-originated CDOs. $90,000, $650,000 fines, censures, bars. April 2025, suspensions for outside business activities and disclosure failures involving EIAs. A small dealer barred for systemic Reg BI non-compliance, 3 to 6 month suspensions, $50,000 plus fines. July 2025, manipulative trading in extended hours sessions. Firms fined for inadequate AI-driven surveillance on insurance-linked derivatives, $200,000 plus fines, 6-month bars. These actions demonstrate vigorous efforts, but still tend to occur after violations, not before. This is Rezny Wealth Management. If you're tired of the conflicts, the mediocre results, and the stress your so-called wealth manager is putting on your financial security, and you're looking for a change, call Rezny Wealth Management. There is a substantial difference when you hire a real money management firm that is 100% fiduciary all of the time.